Hello friends. Last week in my video, I warned you that the market might undergo a slight correction. And thanks to the statements of Russian President Vladimir Putin, who figuratively, of course, dropped a bomb on the markets by saying that all options, including nuclear war, were open to Russia. That spooked the markets, and the latter half of the week, especially Thursday and Friday, saw markets seek lower levels. Will this geopolitical stress take more strain in the market and cause more downward pressure? We are going to see with statistical evidence what lies ahead for us in the week ahead. On your screen right now is the market roundup window, and that tells me that it was the banking space that led the way down. The Nifty, the broader base Nifty, also declined, but probably up to 1/3 of the decline that was seen in banking. Gold went up marginally in spite of the fact that the US dollar index went to a fresh 2-decade high. That was safe haven buying, and in spite of the fact that Friday saw a big decline in commodities, gold has still logged week-on-week gains. That's because of the threat of geopolitical stress. Silver is down, and so is oil and gas. Oil and gas fell, and that's a subject for a separate video altogether. And I'm hoping that I should be able to make one in the near future. The US dollar index, like I mentioned, is at a fresh 2-decade high, and the US dollar versus the Indian rupee is at a lifetime high at 81.12. So we are basically now importing inflation. The 10-year benchmark bond yields. Remember last week I told you I'm going to watch whether 7.29 is overcome forcefully. It was, and we are now at 7.42. In the coming week, on 28th through 30th of September, the RBI Monetary Policy Committee is meeting to consider interest rates and possibly hike, and that is likely to keep markets on the edge. NSE market capitalization shed 1.07%, and the US market triggers were bearish. I have been putting forward the hypothesis that the Indian markets will relatively outperform their US peers, and look at what's happened. The Nifty is down 1.16%, Bank Nifty is down 3.02%, and the lowest decline that the US markets have seen is the Dow Jones Industrial Average at 4%. Of course, the broader the index, the bigger the fall in the other US indices. On your screen right now is the daily chart of the US Dow Jones Industrial Average. The death cross, the 50-day moving average being below the 200-day moving average, remains in place. The price has plunged below the June pivot low at 29,600 odd. And do remember, last week in this video itself, I told you that I'll be watching the 29,500 level very keenly. It was breached on an intraday basis, but the closing was marginally higher. If the Dow Jones Industrial Average is trading sustainably below 29,500, the bulls are in trouble. Let's take a look at the Nasdaq index, which is directly influencing Indian IT, information technology stocks. The bullish triangle marked by blue lines is breached a long time ago. The death cross remains in place, but the June swing low, at 11,037 is the level to watch out for. If at all the Nasdaq 100 drops below this level, you have problem in the Indian IT space as well. The S&P 500 is the broadest index amongst the three US indices that we watch. Here again, the death cross remains in place, and the previous swing low at 3,636 is an area to watch out for. Should this level be violated, the bulls are likely to feel the heat and further declines may not be ruled out. Coming to our in-house market indicators, the MWPL is at a 5-month high at 33.59. Do remember, the coming week is an expiry week, and therefore on Friday, coming Friday, you're more likely to see significantly lower levels. But I have been saying that the bulls have increased their risk appetite, are showing rising risk appetite, and that is both a sign of concern and a sign of optimism. Optimism, of course, risk appetite is higher. Concern, because when the market fall, as per accounting methods of LIFO, last in, first out, traders also tend to have a mindset of LIFO. The most recent positions that they have initiated, which turn loss making, are dumped immediately. So the increased open interest might lead to higher volatility, which of course is being witnessed. How much will MWPL fall on Friday? That remains to be seen. I update all these metrics on my social media account. So if you care to connect with me, my contact coordinates follow at the fag end of this video. Let's now come to the turnover of the indices and individual stock futures. The index futures turnover has risen because traders have participated more proactively in short selling, whereas individual stock futures turnover has fallen a tad. Are normally seen to freeze traders in their reflexes like deer caught in the headlights of a car. So the fact that traders are participating in the selling process tells me that there is force in the selling. Let's now come to the advanced decline ratio. This is an excellent proxy for one marshmallow trader's risk appetite. This very simple tool tells me which way the winds are blowing in the market. And the advanced decline ratio at 0.22 is marginally higher than last week. But it remains at almost the lowest level of a 5-week range. That tells me that risk appetite has collapsed in the absolute near term. Here again, this is a metric that I update on my social media accounts every day. The NSE Nifty and Bank Nifty impetus tells me that the Nifty impetus has risen. Impetus measures the force behind any particular move, and the force has risen. That means the Nifty has fallen with greater selling momentum. The Bank Nifty has fallen for sure, but the impetus of the Bank Nifty has come down, which means that there is a possibility that the force of selling might ease a little. I'm not saying that the force will go away or even reverse. I'm saying that it might ease a little. The basis chart, the basis is nothing but the discount or premium prevalent in the futures compared to cash, shows the Bank Nifty basis rising. This occurs when short covering takes place. At lower levels, a lot of shorts were extinguished on Friday. Remember, Friday saw the lion's share of falls in the market. The Nifty basis, on the contrary, has come down sharply from 35.30 to 8.50, which means that there's been a lot of selling, fresh selling on the Nifty. The basis also falls the closer you get to expiry, because on expiry day, both the premium and the spot prices are hypothetically supposed to converge or match. So watch out for signs of inversion. Inversion is when futures trade at a discount to cash. As long as that is not happening, the bulls still have a slight chance. I now come to the LWTD indicator, which shows the Nifty percentage gain loss line. The blue line has risen marginally but still remains below zero at minus 1.72. So the overhang still remains weak, and the LWTD line, although has risen, still stays below zero at minus 0.03, which means on declines, support will still continue to remain muted or weak. I want the LWTD and the Nifty percentage gain loss line both to stay above zero and rise together if at all the bulls are to come back. Now for the footprint of the four market participant types, I start with the FIIs who've increased their short positions in individual stocks and in index futures alike. So basically, these guys are shorting more proactively in the markets. Where DIIs are concerned, they've increased their index short positions marginally and they've cut their individual stock short positions marginally again. But do remember, DIIs normally tend to support the market in the spot segment. Now for the prop traders, and prop traders have cut their index net shorts and gone into net long with a very small exposure, of course. But their individual stock futures long positions have risen on a week on week basis marginally. Now that is something that we need to watch on the coming weekend's video. Is the position falling? Because do remember, majority of the fall was seen on Friday, so not many people have had the time to react much. What happens going forward is what matters. Now, the retail traders have shown increased risk appetite by raising their net long positions both in the indices and in individual stock futures. Do remember, the retail has been doing all the heavy lifting since COVID-based lockdowns were imposed. So we need to watch this aspect keenly. Now, friends, the new segment that I've started recently, monitoring 4 index heavyweight stocks that swing the indices with themselves. Not only do these stocks impact the Nifty, some of these stocks also impact the Bank Nifty. I start with the biggest boy of them all, Reliance Industry, which has been falling relentlessly, and the second line of defense at 2,542 was also breached. It was breached last week itself, but in the week prior, of course, but last week the declines have only deepened. Now, I want the bulls to take Reliance above 2,550 minimum, if not 2,620, before I can say that Reliance will start to support the Nifty itself. Now, do remember, Reliance has a weightage of 11.51% and beta of 1.11. So that makes it A, a very heavyweight, and B, quite volatile. HDFC Bank is the second stock. It has a weightage of 8.36 in the Nifty and 26.21 in the Bank Nifty. So by itself, it's the largest weighted stock in the Bank Nifty. Whichever way HDFC Bank goes, that way Bank Nifty goes. The first thing that meets your eye is, even though HDFC Bank is still above its support level of 1,421, it has opened and closed below the 25-day exponential moving average, which is a proxy for a month-long holding on cost of an average bull. So the short-term traders are now panicking. They are underwater and in a mark-to-market loss. If the 1,421 level is violated, further pressure ahead. I now come to Infosys. Do remember the Nasdaq 100 chart, fairly bearish. The only slight sign of comfort for technology stocks is that the rupee is falling against the dollar. But as I have explained to you in a past video, it need not be taken as gospel truth, irrespective of what you hear in the public domain, that a falling rupee blindly makes technology stocks a buy. It's not necessarily so, but it might cushion the declines a little bit. So Infi is unlikely to help the Nifty 50 much, in spite of having a weightage of 7.54% with a beta of 1.01. Now this fourth stock, ICICI Bank, has so far been the strongest of the four, and the chart formation was also very robust. But in spite of having a weightage of 7.57% in the Nifty and Bank Nifty weightage of 23.72, which makes it a second heavily weighted stock in the Bank Nifty, in spite of being a critical stock in both these indices, this stock did not receive any buying support. It fell on 4 out of 5 trading sessions, has closed below its 25-day exponential moving average, which is a month-long holding on cost of an average bull. So short-term traders are now in a mark-to-market loss. That is likely to be a pressure point again. Friends, I now come to the bond market, which has rung another alarming note. I have been telling you, do not ignore bonds in spite of feeling that bonds which tend to be boring have no kind of relevance to you as a trader in either equities or commodities or even forex. Do remember that this market is the source of all money supply and therefore extremely critical. If you're a bank nifty trader or a trader in banking stocks, ignore the bond market at your own risk. Look at the way the bond yields have now closed above 7.29. This is a threshold I told you I'll be watching very, very keenly. And lo and behold, you're now within a whiskers distance away from 7.50. Coming as it does, in the week before the RBI's Monetary Policy Committee or MPC meeting to determine interest rates, it tells me that the markets are expecting rates to go up. Secondly, India's short-term liquidity surplus has now turned into a net deficit, which tells you that the RBI's mop-up operations have sucked out money from the money market, and that's likely to create a little bit of a liquidity crunch in the absolute near term. Only money market traders would know this is not the same as equity markets. I'm talking of money markets where money lending and money borrowing is done. But nevertheless, as we've all learned in high school economics, finance is the lifeblood of commerce. So when liquidity is dried out, it's likely to have a ripple effect. Should you continue to ladder your bonds? Yes, I think you should continue to ladder your bonds. Would I deploy more at 7.5, 7.6? Gladly. I would gladly deploy more. And to be very honest with you, I'm pretty pleased that I have been laddering sovereign yields and kind of resorting to asset allocation, which has protected me from the wild swings in the higher risk asset markets. Friends, I now come to the US dollar index, which has gained 3.38 points last week. It rose on 4 out of 5 trading sessions. As the daily chart on your screen tells you, the price has run above the 25-day exponential moving average, which is a month-long holding on cost of an average bull. The trigger, of course, was Russian President Vladimir Putin's a threat of using force, including nuclear force, and asking for 3 lakh reservists in the Russian army to be enlisted, to be sent to war against Ukraine. That witnessed a safe haven buying in the US dollar, and that is precisely what caused all the pressure in all emerging markets, including India, because we then have to pay more for all our imports, especially oil and gas. The weekly chart on your screen tells you that it was a big, large power candle last week, and the price has run significantly away from its 25-week exponential moving average, which is a 6-month-long holding on cost of an average bull. Medium-term outlook remains positive, although the distance between the price and the moving average tells me that there is a possibility of slight profit taking at higher levels. Friends, last week I advocated a range between 111.60 on the upside and 107.70 on the downside. Admittedly, this range was overcome on the upside because the high was 113. Do remember, geopolitical stress caused by Putin saw safe haven buying suddenly coming. In the coming week, I expect a range between 115.10 on the upside and 110.95 on the downside. Do watch this index very, very keenly, because on this, will depend commodity and equity market outlooks. Friends, the dollar index done. I now come to the bank nifty, which saw majority of the selling pressure. It fell 3.02% on a week-on-week basis, and it fell on 3 out of 5 trading sessions, as you can see on your screen. The second most noteworthy aspect of the chart is starting from Wednesday all the way up to Friday, falls have been progressively larger. So it was a small fall on Wednesday, slightly bigger on Thursday, and the largest on Friday. The fact that Friday also makes or breaks the sentiments for the opening levels on Monday, which is why I keep telling you on my social media accounts, watch the final 75 minutes of trade on a Friday. So Friday closing has been quite terrifying for the bulls, and they are facing a mark-to-market loss. The price has fallen below its 25-day exponential moving average and closed below this. So the short-term outlook has been weakened. Do note that the March swing high of 38,759 is still holding. In case of declines, I would watch the round number of 38,000. If the 38,000 level is violated, it would mean that a previous swing low is violated and a lower low formation could be in the making. But till such time, I would think that the bulls still have a fighting chance. And what is my net hypothesis? I think the bulls are likely to be slightly nervous. Do note there is expiry up ahead, and if at all you're a bull, you want to roll over your positions to the month of October, you'll have to pay cost of carry. So not only are you bleeding where mark to market is concerned, but you will add to your costs by paying rollover costs. Will the bulls do that? Those odds are fairly long. Looking at the weekly chart on your screen, do remember in last week's video, I warned you of the inverted hammer that we saw coming at near the peak of the bank nifty. I told you that the inverted hammer was a cause for concern, as is the fact that the price was far away from its 25-week exponential moving average, which is a 6-month-long holding on cost of a bull. So I told you mean reversion would trigger profit taking, and sure enough, last week's candle was a big, sizable negative or a bearish red color candle. The price still remains above, significantly above its 25-week exponential moving average. For scope for further declines cannot be ruled out. So the possibility of the correction deepening still exists. Friends, in the week before last, this index was number 4 on our in-house volatility list. Last week, it fell 2 notches to hit number 6, which is a sign of comfort because individual stock futures volatility went higher than Bank Nifty's volatility ratings. And lower is the volatility, the more comfort it is for a retail trader to be able to tackle his trade. Last week, I advocated a range between 42,300 on the upside and 39,250 on the downside. Do note how the low was at 39,413, which is a mere 163 points above my advocated support level. In spite of all that volatility that you saw last week, our range held. In the coming week, I expect a range between 41,125 on the upside and 37,950 on the downside. Friends, statistical beta or pure price volatility is extremely high, so trade very, very carefully and trade light. I now come to the Nifty 50, which fell 1.16%. And it logged losses on 3 out of 5 trading sessions last week. Like the Nifty, Bank Nifty itself, the falls were progressively larger starting from Wednesday. And what you can see on your chart is that the price has closed below its 25-day exponential moving average, which it had last week itself, but this week the fall has escalated. The 18,115 level, which I advocated as a hurdle that must be overcome, failed to even get tested. Forget about being overtaken and overcome. So, what I would see is what happens near the 17,150 level. The bulls must defend 17,150 in case of declines. Otherwise, they could see further pressure ahead. What I'm also seeing is that the price is below its bearish trend line, which connects all the tops made in October, starting from October 2021, which means that there will be some amount of overhead supply. People who've bought recently and are trapped at higher levels will start to seek an exit and therefore might restrict the price from rising too much. That is the concept of overhead supply. So we might expect some overhead supply. Coming to the weekly chart, last week I told you that the bearish engulfing pattern, the red big powerful bearish candle overwhelming the previous bullish candle, is called a bearish engulfing pattern, would take its toll on the bulls, which it did. The price is higher than the 25-week exponential moving average, which is a 6-month long holding on cost of an average trader. So the medium-term outlook still remains positive as of now. The bulls will need to defend this 25-week exponential moving average. Otherwise, you could see an intermediate downtrend beginning. So that is a threat that we face. In the week before last, this index was number 12 on our in-house statistical beta or pure price volatility rankings. It rose one notch to go to number 11. That's a challenge. In spite of the fact that volatility rose much faster in individual stock futures, the fact that Nifty, being a very broad-based index, saw volatility ranking go up tells me that a retail trader is likely to witness increased challenges to his day trading. So please be very, very careful, trade light, hold your stop losses diligently, and if you don't think you can handle the statistical beta, stay on the sideline. There's no shame in that. Last week, I advocated a range between 18,075 on the upside and 16,975 on the downside, which held perfectly well in spite of all the volatility that you saw last week. In the week ahead, I expect a range between 17,900 on the upside and 16,775 on the downside. I remind you, at the risk of sounding repetitive, that statistical beta is climbing rapidly. Please restrict your turnover, your exposure, and do not forget to keep your stop losses. Friends, I now come to the retail risk appetite, which is denoted by the percentage turnover logged in stock options versus stock futures. What we are seeing is that individual stock options turnover remained almost unchanged on a week-on-week basis, but individual stock futures turnover actually is showing a higher degree of contribution in the overall metrics. That tells me that there was possibly is the operative word here, a little bit of distribution taking place in the futures segment. So long positions are being cut, which is normal, partly due to the impeding expiry, but it also tells me that there is a minor red flag here. Last week, I told you there were seven red flags on the markets in our statistical model. This week also, this remains a red flag. So caution is the buzzword here. Friends, I now come to the most popular segment of this video for statistical beta traders, statistical model traders. I give you 5 stocks which have gained statistical beta or impetus on Friday. So you take small exposure, wait for large price moves on Monday, and 5 stocks that have lost impetus on Friday. So you take big exposure, wait for small price move on Monday. This is for scalpers. This list is valid only for Monday. Should you wish to be updated Tuesday through Friday, please join our Telegram channel. The details are in the description and in the pinned comment below this video. So the list of impetus gainers is led by Mahindra Finance, number 1, number 2, Page Industries, number 3, Hind Unilever, number 4, Canfin Homes, number 5, Muthoot Finance. The impetus losers list for Friday is led by Navin Fluorine, number 2, Adani Ports, number 3, Container Corporation, number 4, Z, and number 5, Alchem. Before I conclude this video, I humbly remind you to subscribe to my YouTube channel if you haven't already done so. In the comment section, do let me know what you think about our video and what you'd want me to record next. I'm always eager to hear from you. Share my videos with your family and friends and social media groups to help me reach out to a larger audience and spread the message of knowledge-based trading systems. Thank you for your patience in being with me in this video. This is Vijay Bhambwani signing off for now. Have a very, very profitable week ahead. Bye-bye.